IBM is currently trading close to one of its highest forward price-to-earnings multiples of the last decade. This video will showcase market reaction against elevated valuation paired with business performance. For much of this period, the market valued IBM at approximately 10 to 15 times expected earnings. Today, that multiple is above 23. That might be reasonable if IBM had transformed into a high-growth technology company, but analyst estimates tell a very different story. Expected earnings growth is mostly in the high single digit. Revenue growth remains modest, and the current PEG ratio is considerably higher than what investors would normally associate with an attractively valued growth stock. IBM may still be a strong and highly cash-generative business, but at this point, investors are no longer paying for the IBM that exists today. They are paying for a much faster growing version of IBM that still needs to prove itself. Let's begin with the current valuation. IBM trades at approximately 25 times trailing earnings and just over 23 times forward earnings. The difference between the two is relatively small, and that matters. With a rapidly growing company, the forward price to earnings often sits far below the trailing PE, because earnings are expected to increase, hopefully sharply. But IBM's trailing multiple is around 25, while its forward PE is still around 25 at 23. That tells us that expected earnings growth is positive, but not especially powerful. At the same time, IBM's 5-year expected PEG ratio is approximately 2.7 times. That is a demanding growth-adjusted valuation. The market is not merely valuing IBM as a stable, mature technology business. It is assigning IBM a premium multiple, despite relatively modest expected growth. A forward PE of 23 does not sound extreme when viewed in isolation. Many high-quality technology companies trade well above that level. But valuation must always be considered relative to the company's own growth profile and historical trading range. IBM spent many years trading at near 10 times forward price to earnings, even during more optimistic periods. The multiple was generally between 12 and 15 or so. The market has now repriced IBM into the low to mid-20s, and that represents a major multiple expansion. Investors are currently paying more than twice the earnings multiple that they were willing to pay during parts of the previous decade. For that re-rating to be justified, IBM needs to demonstrate a structurally stronger business with much faster growth and better margins and a more durable earnings trajectory. Without that improvement, the stock is vulnerable to multiple compression. This is where the overvaluation becomes much harder to ignore. Consensus estimates suggest that IBM's earnings will grow by approximately 7.6% in 2026, 8% in 2027, and about 10% in 2028. Then, in 2029, the estimate shows here that actually there is an indication of a decline of approximately 3.8%. These are not poor numbers for a mature company, but they are not the growth rates normally associated with a stock that is trading at the premium technology multiple. So, IBM's estimated PE falls only gradually, from approximately 23 in 2026 to around 19 in 2028. It then rises again to approximately 20 in 2029 because expected earnings growth weakens. This is not a company rapidly growing into its valuation. It is a company whose valuation remains elevated even several years into the analyst forecasting period. The PEG ratio makes the valuation concern even clearer. IBM's 5-year expected PEG ratio is approximately 2.68. A PEG ratio near 1 is sometimes used as a rough indication that valuation and expected growth are reasonably aligned. A ratio significantly above 1 suggests that investors are paying a large premium relative to the company's expected earnings growth. At 2.7, IBM is not simply expensive on a PE basis. It also appears expensive after adjusting for any growth. And unlike a younger software company, IBM does not have the obvious path to sustaining 30, 40 or let's say 50% earnings growth. So, The investment case, therefore, depends heavily on the market continuing to award IBM a premium multiple, and that creates a risk. If IBM continues growing earnings at only 7 to 10%, investors may eventually question why the stock deserves to trade above 20 times forward earnings. To be fair, IBM's operating performance is improving. Over the last 12 months, revenue reached approximately almost 70 billion, 68.9. The platform shows revenue growth at around 9.7, which is stronger than IBM's recent historical performance. Gross margins has also improved to about 58.4, and operating margin is about 18.2, up meaningfully from several previous years. And last 12-month net income is shown at approximately $10.7 billion. These are positive developments, obviously. IBM is producing better growth and stronger profitability than it did during some of its weaker years. But the critical question is not whether IBM has improved. The question here is whether the improvement is large enough to justify this new valuation expansion. Revenue growth around 10% may support a higher multiple than IBM's historical 10 times valuation. But in my opinion, it does not automatically justify paying more than 23 times expected earnings. IBM's reported net profit margin is approximately 15.6%. Using the visible figures, approximately $10.7 billion of net income on $68.9 billion of revenue produces a margin close to that level. That is respectable for a large mature technology and consultancy company, sure. But IBM's net margin is nowhere near the 40% or plus margins that we have seen in companies such as Palantir. That distinction matters. A company with a 40% profit margin and very rapid earnings growth may justify a much higher valuation multiple. IBM is profitable. It most certainly is stable. But its profit margin profile and growth rate remain characteristic of a mature business. Investors are therefore paying a growth company multiple for a company that still has mature company financial characteristics. IBM does generate meaningful cash flow. Over the last 12 months, operating cash flow is shown at approximately 14 billion. Capital expenditure, almost 2.3 billion. Using a simple operating cash flow minus capital expenditure calculation, that produces about $12 billion of approximate cash flow, free cash flow rather, and that is strong. It does provide IBM with the ability to pay dividends, reduce debt, as well as invest in acquisitions and repurchase shares. Stock-based compensation is also much less aggressive, as we can see, relative to revenue than it is for many younger tech companies. So the concern is definitely not that IBM is a weak or low-quality business. The concern, in my opinion, is the price investors are currently paying for that cash flow. At the current valuation, IBM needs several things to go right. Revenue growth needs to remain stronger than its historical average. Margins must continue expanding. IBM's software and AI strategy must produce measurable earnings growth rather than only optimistic headlines. Consulting demand must remain resilient. And perhaps most importantly, the market must continue accepting a forward PE of above 20. If one of those assumptions break, the stock could fall even if IBM remains profitable and continues growing, albeit modestly. The bull case is that IBM has genuinely transformed. Revenue growth has improved, margins are expanding. The company produces significant cash flow. Its software operations and recurring business revenue create greater stability. And if IBM's artificial intelligence strategy produces meaningful results, sustained demand, analysts may underestimate future growth. Under that scenario, the current valuation could prove reasonable, especially if earnings growth moves consistently into the low to mid-teens. And the bear case, which is, in my opinion, much more immediate. IBM's forward PE is close to the upper limit of its decade-long range, basically. There is no getting away from it. The PEG ratio is almost 2.7. Expected earnings growth remains mostly below 11%. And the 2029 forecast shown here implies an earnings decline. Although IBM is highly profitable, its margins profile still resembles that of a mature tech and consulting company. That combination creates substantial multiple compression risk. If the market eventually decides that IBM deserves a forward PE of 15 or 18 rather than 23, the stock could decline significantly even without any collapse in the underlying business. To understand the risk, consider a simple multiple compression example. At a share price of approximately $290 with a forward price to earnings of 23, let's say, the implied forward earnings per share are approximately $12.50. If those earning estimates remain unchanged but the market reduces IBM's forward PE to 20 from 23, the implied share price would be about $250. At a multiple of 18, the implied price would fall toward $225. That would not require a recession or a collapse in its earnings. It will only require investors to apply a more conservative valuation multiple. So, is IBM overvalued? The company itself is not the problem. IBM is profitable, cash generative, and showing meaningful operational improvement. Revenue growth has strengthened, margins have expanded, and free cash flow remains substantial. But the stock price appears to have moved much faster than the company's underlying growth rate. At approximately 23 times forward earnings and a PEG of 2.7, let's say, IBM is being valued as though it has stronger growth than it already has. Yet consensus estimates currently show earnings growth mostly between 7 and 10%. And that creates an uncomfortable mismatch. The investors are paying a premium growth multiple for a business that is expected to deliver a mature level company growth. My conclusion is that IBM remains a good company, but at almost $300, the stock price appears overextended. The risk is not necessarily that IBM's business will collapse. I don't believe that it will. The risk is that the business performs reasonably well, but the market decides that it has been paying too much. In my opinion, a company should be trading at perhaps even below 200 in order to maintain its historical price to earnings ratios.